Okay, let's dive right into this explainer and pull back the curtain on why the market so often feels like it's literally rigged against your trades. Look, if you've ever bought a textbook breakout only to watch the market instantly reverse and absolutely crush your position, well, you are definitely not alone. Today, we're dissecting the predatory logic of high-frequency algorithms, and we're going to expose how they systematically exploit retail traders.
We need to start with a pretty harsh reality check. That breakout you just traded, it wasn't a market shift. It was a carefully engineered liquidity trap. You know, we so often blame bad luck or maybe poor timing when a trade goes completely sideways. But the truth is actually way more calculated. In today's market environment, that beautiful technical setup you just bought into wasn't a genuine shifted momentum at all. It was a trap, designed specifically to use your entry as their exit liquidity. It's a highly predatory system, and it's constantly operating right behind the scenes.
So the obvious question here is, why? Why are traditional breakout patterns, the exact setups we've all been taught to trade for years, now functioning as intentional bait? We're talking about your classic bull flags, your cup and handles, basically the absolute staples of manual charting. Well, big banks and high-frequency trading firms are fully aware that you are watching those exact levels. Their algorithms are specifically programmed to trigger false signals around these classic patterns, literally hunting for your stop losses. Let's look at exactly how they managed to pull this off.
Section 1. The institutional liquidity trap, the illusion of the breakout.
This is where human psychology collides with raw computing power, and honestly, it creates a massive mismatch. Think about it like this. On one side, you've got manual charting. You're analyzing static levels, relying on human reaction time, and trying to read retail sentiment. But on the other side, institutional algorithms are actively engineering a retail wall using proprietary AI. They have a staggering 10,000 to 1 speed advantage over us. They operate in sub-millisecond clusters, utilizing predictive latency and focusing entirely on institutional delta. So while you're sitting there waiting for a candle to close on a static chart, they have already calculated the exact amount of volume needed to lure you in, and they've executed thousands of trades. It's wild.
Section 2. Anatomy of the Hunt, Millisecond Execution.
If we actually slow down this sub-millisecond timeline, we can spot this ruthless pattern we call the wash and rinse sequence, and it plays out in 3 incredibly rapid steps. Step 1, the algorithms spoof high-side offers to make the order book look just unbelievably bullish. Then, step 2, this creates a sudden price spike, which triggers retail buy stops. Retail traders see that breakout, panic that they're going to miss the big move, and boom, they jump in. But step 3, well, that's where the trap snaps shut. The second that breakout candle reaches peak retail participation, the algorithm instantly flips from price discovery to predatory execution. Using that predictive latency modeling we talked about, the bots reverse the flow and ruthlessly hit the stop-loss clusters they know are hiding right below the support line. Your stop-loss is triggered, and they just absorb all your liquidity.
Section 3. Decoding institutional footprints, seeing the invisible trap.
Now, to actually spot this high-frequency signature before you commit your hard-earned capital, you really need to look for iceberg orders. What are these? Well, they're massive institutional orders that have been strategically broken down into tiny hidden pieces. The entire goal here is to completely absorb retail buying momentum without letting the price move up even a fraction of a cent. The big money is literally hiding in plain sight. It creates this massive divergence between what retail sentiment feels like, everyone thinking the price is pushing up, and the actual institutional reality, which is massive selling pressure quietly absorbing absolutely every single buy order.
Another major illusion they use is flash volume. You might glance at your volume indicator, see a huge spike, and think, okay, great, that confirms the breakout. Actually, scratch that. It's totally artificial. Bots intentionally generate this flash volume at lightning speed to simulate an organic market move. But when you combine the detection of that flash volume with advanced heat map analysis, suddenly the truth reveals itself. You'll see massive, passive institutional sell orders just chilling there, waiting right above the breakout zone. They're basically painting the tape just to make you buy directly into their sell wall.
Section 4. Surviving algorithmic environments, from hunted to hunter.
So how do we fix this? Here are the actionable survival tactics you need to start using. First up, you absolutely must prioritize post-hunt stability. Stop chasing that initial candle spike. Wait to see what happens after the algorithms sweep the liquidity. Second, you have got to integrate level 3 data into your workflow. You can't fight a 2026 algorithmic war using 2010 static charting tools, right? Third, monitor order flow imbalances constantly so you can spot the trap before it snaps.
Ultimately, your main goal is to align your execution with the big money flow. But let's be totally honest here. Adapting to all of this manually, it's incredibly difficult, which naturally brings us to a quantitative approach.
Section 5. Inside Quant's Haven Portfolios, the Quantitative Armor.
Look, if high-frequency algorithms are exploiting emotional, manual trading, the most logical way to fight back is by stepping inside Quant's Haven portfolios. These are auto-generated portfolios that dynamically group the top 10 strategies based on very specific performance metrics. Let me give you an example. The top K-ratio portfolio generated a total P&L of over $349,000, all while maintaining an exceptionally smooth equity curve and a Sharpe ratio of 3.08. Or take the lowest drawdown portfolio. It managed a really solid $101,000 profit while keeping the maximum drawdown to a microscopic 3.06%. By grouping these algorithms together, you're effectively diversifying your risk and throwing a layer of armor over your capital to protect against those localized liquidity traps.
A compound annual growth rate of positive 194%. Seriously, let that sink in. This comes directly from the top expected value portfolio, and it visually proves the power of fighting algorithms with algorithms. When you finally stop trying to manually outclick a machine and instead deploy an automated, mathematically sound system, you step completely out of the trap and right into a structured performance curve.
And check out this striking metric, a 9.70 return to drawdown ratio. This is from the top Sharpe ratio portfolio setup. Seeing a metric this high highlights some seriously efficient risk management. It means the system is purposely designed to maximize your returns while strictly limiting downside exposure. And frankly, that is exactly the kind of logic you need to survive in a market crawling with predatory bots hunting for oversized stops.
Now, as always, we do need to ground this explainer with a very important mature reality check. Under CFTC Rule 4.41, it's vital to understand that the impressive metrics we just walked through do have limitations. These are simulated performance results. That means they're designed with the benefit of hindsight, and they don't represent actual executed trading, which, could always be impacted by factors like a sudden lack of liquidity. Furthermore, trading futures and foreign currency inherently contains substantial risk. You should only ever trade with risk capital, money you can actually afford to lose without it jeopardizing your financial security. Always remember, past performance is not necessarily indicative of future results.
Which brings us to one final, critical question. Now that you understand the massive 10,000-to-1 speed advantage these algorithms have over your static charts, and you've seen exactly how classic patterns are used as intentional bait, what's your next move? Will you continue being the market's exit liquidity, or will you evolve your approach and join the algorithmic hunt? Rethinking your manual habits and exploring quantitative strategy portfolios might just be the single most important shift you ever make. Think about it.